Hello and welcome back to our InvestEd vidcast series. I'm Colby Feen and I'm here today with Mark Armbruster to talk about stock splits. Apple reported their quarterly earnings last week, and as part of the announcement, they declared a 4-for-1 stock split to be effective August 31st of this year. Mark, what does this mean for investors?
Technically, it means that investors will end up with 4 times as many shares as they owned before the split. But practically, it doesn't really mean anything. Because while you end up with more shares, each share will only be worth 1/4 of what it was worth before the split. 4 times as many shares, but each worth 1/4 of the previous value. That means the total value of your holdings should be the same before and after the stock split.
And why do you say they should be worth the same? Are they or aren't they?
There are always complications in the world of finance. One issue is that there are other things that can drive the stock price from one day to the next, including additional company announcements, economic data releases, or even just investor sentiment on any particular day. But holding those things constant, a stock split should not have any impact on the value of the position.
And there you go again. You keep saying should.
Right. Another complication is that while mathematically a split shouldn't make any difference at all, behavioral issues do tend to push stocks higher after splits occur. NASDAQ did a study of stock splits and found that companies declaring splits tend to see their stock rise 2.5% on average after the announcement, and then another 2.5% over the subsequent year. There are numerous academic studies with similar findings. And in fact, Apple rose 10% on the day it announced its split, but that could have been partially because of their strong earnings report on the same day, and also there's very favorable sentiment currently for large cap technology stocks.
So if there isn't any practical impact from stock splits, why do companies do them?
Mostly to make their shares more attractive to a larger shareholder base. When per-share stock prices get too high, often smaller investors shy away. Apple stock now trades at over $400 per share, and so if you want to buy 100 shares, that comes to $40,000. Trading in round lots, which are multiples of 100 shares, used to result in lower trading commissions. That isn't really the case anymore, but investors can still be put off by shares that trade at a very high price. A good example of this is Berkshire Hathaway. Warren Buffett doesn't believe in stock splits, he doesn't see any practical reason for them, and consequently Berkshire Hathaway stock now trades at almost $300,000 per share. Let alone round lots, most investors can't afford to buy a single share at that price. And Apple has split its stock 4 previous times since it went public. Most were 2-for-1 splits, one was 7-for-1. But if those splits hadn't happened, the stock would now trade at over $10,000 per share, which would put it out of reach for smaller investors.
And so what about future payouts? What happens to Apple's dividend after the split?
Like the price of the shares, the dividend also gets quartered, but paid on 4 times as many shares, so the total dividend payment to investors won't change as a result of the stock split.
So the takeaway here is that stock splits attract a lot of attention. The math would maybe suggest that nothing really changes, but behavioral issues tend to push shares higher, which can be self-reinforcing through time, causing even more excitement with investors.
That's right. It would be hard to devise a whole investment strategy around buying stocks that recently split, but there can be short-term benefit to those who are lucky enough to already hold those shares.
Well, Mark, thank you for joining us today, and thank you to our listeners. We look forward to bringing you the next edition of our InvestEd vidcast series. Please feel free to contact us if you would like to talk more about stock splits or any other investment topic.